The economic environment of business refers to the conditions and factors that affect how businesses operate, including economic growth, inflation, interest rates, exchange rates, and government policies. This environment is constantly changing, and businesses must be able to adapt to these changes in order to remain competitive and profitable. Here are some key components of the economic environment of business and examples of how they can impact businesses. Economic growth. Economic growth refers to the increase in the production of goods and services in an economy over time. When there is strong economic growth, businesses typically benefit from increased consumer spending, higher profits, and increased investment opportunities. Conversely, when economic growth slows down or declines, businesses may experience lower demand for their products or services, which can lead to lower profits and reduced investment. For example, during the COVID-19 pandemic, many businesses experienced significant declines in demand due to the economic slowdown caused by the pandemic. Conversely, companies that provided essential goods and services, such as online retailers and grocery stores, saw increased demand. Inflation. Inflation refers to the rate at which the general level of prices for goods and services is rising. When inflation is high, businesses may face higher costs for raw materials, labor, and other inputs, which can lead to lower profits. In addition, inflation can reduce consumer purchasing power, which can lead to lower demand for products and services. For example, in the 1970s, the United States experienced high inflation, which led to increased costs for businesses and reduced consumer purchasing power. This period was particularly challenging for industries such as automobile manufacturing, which faced increased costs for materials and labor. Interest rates. Interest rates refer to the cost of borrowing money, and they can have a significant impact on businesses. When interest rates are low, businesses can borrow money more easily and at lower cost, which can lead to increased investment and expansion. Conversely, when interest rates are high, businesses may be less likely to invest and may face increased costs for borrowing. For example, in the aftermath of the 2008 financial crisis, the Federal Reserve in the United States lowered interest rates to stimulate the economy and encourage borrowing. This led to increased investment and expansion in many industries. Exchange rates. Exchange rates refer to the value of one currency in relation to another currency. Changes in exchange rates can have significant impacts on businesses that operate in international markets, as they can affect the cost of importing and exporting goods and services. For example, if a U.S. company sells products in Europe and the euro strengthens relative to the U.S. dollar, the company may face lower profits due to the increased cost of importing materials and exporting goods. Government policies. Government policies can have significant impacts on businesses, as they can affect taxation, regulation, and other aspects of the business environment. For example, changes in tax policies can affect the cost of doing business, while changes in environmental regulations can affect how businesses operate and the products they produce. For example, the implementation of the Affordable Care Act in the United States in 2010 had significant impacts on the healthcare industry, as it required businesses to provide health insurance to their employees or face penalties. This policy led to changes in the way healthcare businesses operated and the products and services they provided. In summary, the economic environment of business is complex and constantly changing, with a range of factors that can impact how businesses operate and succeed. By staying informed about these factors and adapting to changes in the environment, businesses can remain competitive and thrive over the long term.